I'm a bit slow, as you know. So you can get more cover at the default premium rates if you're a white collar.
White collar, blue collar, but I don't see it that way.
In your early 20s, it will be quite low. In your 30s and 40s, it will get a bit higher because that's when they assume that, with mortgages and children, that's when you need the most cover.
Health considerations, all things being equal, it's really easy to say, hey, move this policy somewhere else because CMS is quite expensive.
If you just set it and forget it, your premiums can probably ramp up really significantly versus if you just left it as that age-based cover.
Not many people pay off their mortgage in less than 30 years.
Hope to be one of them, but
yeah, let's be very candid. Most people, they start paying it off quicker and then they go, oh, actually, I want to upgrade the house,
Yep.
and then bounce into another mortgage for another 30 years.
Yep.
So, hey there, welcome back to another deep dive, and we are talking about comparing the pair. Not all super fund insurance is created equal. Our ASIC has found that more than 70% of superannuation accounts with insurance have the default cover automatically provided by the super fund trustees. But many Australians don't know what they're covered for. So today we're breaking down what that means, what is actually covered, and how different funds can really be worlds apart. And today we've got one of our amazing advisors, Lenny. Thanks for joining me, Lenny.
Thanks for having me. Hey, everybody.
So Lenny, talk to me, what does automatically provided insurance mean inside of super?
So for the most part, like I said, most Australians have insurance inside their super fund, and that cover is as part of their membership. When they join the fund, they receive that cover. They probably didn't have to actually do anything to get that cover, and it will just be a basic level of cover with typically a few different products, if all three, which would be death, total and permanent disablement or TPD, and income protection are the main ones that you see there. Most members would have that sort of cover, the exceptions being primarily if you're under the age of 25 or if you have a balance of under $6,000, then that might not kick in automatically. You'll have to opt in early.
So the main question I have is, do all super funds have the same cover? Is it like a templated amount that everyone gives? What does that look like?
No, they can actually vary quite significantly. So in my research, I found that there can be differences in the types of cover that's being offered. So some providers include life and TPD and income protection, some just life and TPD. And there was, interestingly, with Hester, they offer life and income protection, but TPD wasn't offered as standard. So that's kind of cool. And you can actually get big differences in how much you receive in terms of the sums insured. The premiums can be significantly different as well. And when it comes to income protection, there can be differences in the default waiting period you receive as well as the benefit period as well.
Yeah, and which doesn't make it easy for a member because, and we'll touch on this, but those numbers can change as well. So whatever you look at on your statement 12 months ago, 2 years ago, may be different to today as well. I mean, everything when it comes to insurance is important, but one of the important things is the benefit amount. So how much are we getting paid out if we ever need to claim on it? So how does that get factored in and calculated?
There's a few different ways the super funds will set that up, but the three main ones are age-based cover, unitised cover, fixed cover, and in very rare circumstances it can be salary-based as well, but we're seeing that less and less these days and more with the public sector funds. So with age-based and unitised, you'll see that the sum insured will change over time. Typically when you're in your early 20s, it will be quite low. In your 30s and 40s, it will get a bit higher because that's when they assume that, with mortgages and children, that's when you need the most cover. And then when you're getting closer to retirement age, it will start to come down. So the difference between age-based and unitised is age-based is that fixed figure, whereas unitised is that number but divided by a certain amount of units. So there's a little bit more flexibility when it comes to unitised.
Yeah.
And then there's fixed, which is typically not offered as the standard option, but something you can later opt into. So you convert either your age-based or your unitised cover into fixed. So that way, as you're getting older, that amount doesn't change, but the premiums will.
Okay, so touching on premiums a little bit. So how, based on those different styles of, unitised or age-based or fixed, how did the premiums get impacted by those different options?
Yep. So with fixed, like I said before, is you cumulatively over time, the premiums that you pay are going to be higher than the age-based or unitised because the amount of cover that you're having is higher. As you're getting older, your risk of claiming is higher, therefore your premiums are going to be higher. But with age-based and unitised, the trustees are trying to manage that for their members a bit more. So as your cover is coming down, even though your risk is going up, your premiums are a little bit flatter than that fixed cover.
Yeah, so I mean, the example is if you're 35, you may have like 250 grand depending on the super fund, and your premiums were based on a 35 with 250 grand. If you have that fixed, when you're 50, your premiums will be much higher because now you're 50 with a 250 grand. But the unitised may, when you're 50, your level of cover may come down to $100,000. And so therefore the premiums are much cheaper. So it flattens out that cost over time. But if you ever need the money and you're claiming, you're only getting $100,000 versus the $250,000.
Yeah, absolutely right.
So talk to me again. We don't. There's a lot of variability when it comes to premiums based on the funds, based on a whole bunch of factors. But talk to me just broadly about premiums and how they work between the funds.
So between the main super funds, there will be a different pool of members that they tend to attract, particularly in the olden days when you used to be in a certain industry, you would use that super fund. So you'll see, even as I was just doing my research, there is a lot of variability in terms of the premiums. Like, for example, there could be 2 to 5 times the premiums for per $1,000 of cover can actually be quite significant, particularly, say, with CBUS, where they historically had a lot of blue-collar workers in higher risk jobs compared to, say, Australian Super, who have a really broad reach of members.
And because the insurance is a pool, and that pool is limited to that member base. So, yeah, CBUS, they insure higher risk occupation. So if you're an accountant and you're in CBUS, you're likely going to be charged a significant amount of money because you're with that high risk pool. And so, yeah, CBUS is kind of a real easy one. When we see a CBUS cover and someone, especially if they've increased their cover, it's crazy expensive almost all the time.
Slam dunk.
Yeah, it's really easy. If, health considerations, all things being equal, it's really easy to say, hey, move this policy somewhere else because CBUS is quite expensive.
With that said, though, depending on the fund, they might have opportunities rather than going through any medical underwriting, is just answering a few questions and being able to move into a different occupational rating, which could reduce your premiums quite significantly, anywhere up to, say, 50% to 75%, depending on the fund.
Now, there's hundreds of different super funds. They've all got different contracts, but let's touch on some of the bigger super funds and what are their default levels of cover and how they're different between their members.
Yeah, so I was doing some research on this, and for, say, a 30-year-old with HESTA, you're looking at close to $135,000 of life cover versus with Australian Retirement Trust or ART, you're looking closer to $250,000. So that's almost double the amount of cover for the same age.
And again, just to not say anything bad about HESTA, they offer the income protection for a long period of time, and they're super unique in the market.
Yeah, age 67 you can get it up to, but even with their default, it's 5 years.
Yes, yeah. So, and it's a low level of cover. It's $950K, I think, from memory, or $1,000 per month.
$1,000 per month. Yeah.
I'm showing my age. It used to be 950. They increased it to 1,000. And we'll touch on the changing landscape of it as well later. But yeah, these default covers, they can change. So ART may decide for all their members they want to boost that 30-year-old's cover up to $300,000, or they may bring it down. But I think when we talk about levels of cover, one of the downsides is that the level of cover is really significantly low for most Australians as well. All right, so the other thing is that impacts premiums is occupation. So let's talk about occupation ratings between the funds. Like, can we, how does that all work?
So typically when you receive that default cover, they will put you in whatever their default occupation rating is. It might be light blue, it might be manual, but it's typically one of those higher risk occupations. And so you're often able to change that. There might be 1 or 2 occupations, there might be a few more, and you'll be able to adjust that with just a short questionnaire, typically without medical or previous claim history or application history information, and that way you'll be able to save upwards of 20-30% in premiums just by making that slight change.
Does that require like a medical check or anything like that?
No medical checks. There might be a few questions that are really high level on your health, but that really does depend between the funds. In
true Lenny style, you've done heaps of research on this. So talk to me about some of the different funds and their occupations.
Yeah, like for example, Australian Super default is their default occupation rating is blue collar, but you can just with a simple questionnaire adjust that. Whereas Australian Retirement Trust, you can only adjust your occupation rating if you go through their tailored insurance offering, not the default offering. Yeah. The only slight change of that is in the first few months of your membership, you'll be able to opt into a white collar cover. where you get slightly extra cover at no extra 50% worth of extra cover at no additional cost, and it'll be on white collar rates. But other than that, there's no other nuances between the occupation ratings.
Sorry, I'm a bit slow, as you know. So you can get more cover at the default premium rates if you're a white collar.
Yeah, and it sort of ties into a lot of these super funds will have a special offer, but it's only really available for, or can be between 60 days, 90 days, 120 days, somewhat up to 6 months with CBUS, but that's a rarity. So it really is only in that short window of when you first join where you're able to opt into these sorts of things. Some of them have some health questions. Some of them have previous insurance application questions where if you've been declined or received a loading and things like that, where they will preclude you from using that special offer. But it's really something to be mindful of if you need additional cover that maybe you can't get cover elsewhere.
Yeah. So like if you're joining a fund, that's your time to really take it serious and go, okay, do we need to make any adjustments and what do they allow?
Yeah.
Because some funds won't be as open with here's all the offerings we have, because they're effectively giving more generous terms, and it is costing the rest of their members for these additional benefits as well.
Absolutely.
So it's one of those things you've got to be aware of what your fund offers when you're joining a fund, and I think people are moving funds much less these days than they used to.
Yeah.
And so it's less of a thing than it used to be, but it's still something to consider if you are, uninsurable, or, can we look at moving super funds and opt into that increase? Yeah. But again, they may have medical underwriting questions. There's a whole bunch of stuff. Does that actually apply to like all types of cover, or is it just life insurance only? Is it income protection? Like
The special offer?
Yeah.
It actually also really does depend on that super fund. So in terms of the special offer, we've got...
Sounds like we're doing an infomercial. We've got this special offer for you. Sign up for insurance.
So with Hester, the special offer covers the death and income protection. It does include a short personal statement with questions relating to health and if you've previously had an application decline, but it doesn't include TPD. That you'd have to go through their tailored route for that.
Yeah, which is really interesting. They'll let you increase income protection, but not TPD.
I'm really interested to know why they've left TPD off the table with Hester. With UniSuper, their special offer for death and TPD is with no health information in their questions, and you have 180 days to opt in for that. And I believe it's an extra 10 units, and you get 10 units to start with.
Yeah. And again, it's unitised, so that will go up or down depending on your age at the time. Okay, so we talked about fixing cover. Let's talk about, I know you've done your research on who does and who doesn't offer that. So, and then also, when would someone maybe consider doing that?
Out of the 15 or so funds I looked at, most of them were industry funds, but there were a few public sector as well. For the most part, most of them did. I think it was 10 out of 14 offered fixing, which is, that actually surprised me. As advisors, we don't see it that often being recommended, but it's certainly something to consider if you aren't able to increase your cover elsewhere through retail offerings or those special offers. And perhaps you'll have a look at that age-based table. Perhaps you're on the upper end and you can see that as you're getting older, that cover is starting to come down. But you'll know that, I need more than that. My debt is more than that cover, that how much I'm being insured for. Consider fixing then, because then it won't start to come down.
Yeah, and those taper off rates are pretty substantial. They come off pretty quickly, and and it's something that especially as you're getting older and you got to manage cost. Obviously, that's a big part of it. But they start tapering off in your late 30s as well. So it's not like, okay, when I'm and most people are still having kids in their 30s, still buying their first house in their 30s, and knowing that level of cover is coming off at the late 30s is concerning. So that's a good time to fix, or older than that, when hey, my exposure is going to either increase or stay relatively the same, because not many people pay off their mortgage in less than 30 years.
No, hope to be one of them, but...
Yeah, but it's, let's be very candid. Most people, they start paying it off quicker and then they go, actually, I want to upgrade the house, and then bounce into another mortgage for another 30 years.
Yep.
So the total amount of lending and paying off a mortgage is often more than 30 years for most Australians. And so, it is important to consider fixing as a part of their insurance portfolio.
One thing to note when we mention tapering, though, is that even if you do fix the cover, often when you turn 60-ish, you start to find that your TPD cover will start to come down by maybe 20% per year regardless, even if you have fixed it. So that's something to be mindful of as well. It's not a set and forget all the way through until you retire at, say, age 65.
Yeah, that's a good note just on those possible downsides. Are there any other downsides of fixing?
If you just set it and forget it, your premiums couldn't probably ramp up really significantly versus if you just left it as that age-based cover.
So fixing it, is it hard to do?
No, the super funds don't make it very easy to do on the high level, but once you've taken a look, it says, oh, you just need to do a form. It might be a fix your cover form or adjust your insurance form. Put in your details, say I'd like to fix my cover, sign it off, send it in, and that's as far as it needs to go for the most part.
Okay, so if a client comes to Skye, are we just going and ignoring that default cover because, hey, we're going to set them up with some, retail cover that we can get as advisors, or do we actually look at that retail cover and consider it as part of the overall, need for the client?
We absolutely do look at what they currently have. And because the reality is not everyone can obtain retail cover, or if they can, it can be prohibitively expensive, or there might be exclusions on there, or perhaps they can't get as long of a benefit period with income protection, all sorts of things. Or if they're smokers, that those premiums can be very significant as well. Whereas often with these default offerings, even if you've opted into the special offer for additional units, they don't often consider things like smokers' rates or pastimes as well, like, risky activities such as rock climbing or even cycling can sometimes come with additional premiums per some $1,000 sum insured. So having that default cover as well as a complementary approach is a very common strategy we see at Skye and recommend.
And the other thing, and we haven't touched too much about this on the default cover, the reason it is a low level of cover is because often default cover won't have any pre-existing health exclusions. And so that's why we think it is a great option for clients, although well underinsured for 99.99% of all Australians. It's well underbaked. But the super fund managers and the insurance company manage the risk because they can't give super generous terms to every client who may have significant health history without it significantly impacting their costs. So that's why we love to consider it and maintain it for a good portion of our clients. We say keep that where it is. That's great for what it allows us to do, to have and not impacting a pre-existing health condition. However, it's not enough, and we'll top it up with some tailored cover that can't adjust or can't change over time as well.
The good point on the pre-existing conditions, though, is that it doesn't necessarily cover everything that you've experienced in the past, particularly as you've first obtained that cover. There's typically a limited cover period of, it could be 30 days, it could be a few months, it could be up to 2 years, where initially that policy will not cover you for any pre-existing conditions prior to that cover going into force.
So we're talking about the default cover is really good. Why do I actually need to come in and see a financial advisor? Why don't I just go to my super fund and increase it if it is so good?
Well, it's not only us recommending different products that we do as part of our advice process. We calculate how much you need, so using your personal circumstances. So rather than just being in multiples of certain units or, say, doubling the age-based cover that you can through this, or even tailoring it yourself using some calculators, we want to make sure that you're informed and making informed choices about how much cover you're taking out, and whether that is through your existing super fund and keeping that or taking out new retail cover. We also find that the cost on a like-for-like basis when we compare retail cover versus, say, industry fund cover, the cost can be very significant on a like-for-like basis. And the other point is that the industry fund cover doesn't always have the bells and whistles that we believe are important. So it's although it's certainly got its place, it doesn't replace the benefits of going through a financial advisor and looking at your options for retail cover. Typically, these industry funds and public sector funds, their insurance offerings aren't guaranteed renewable, meaning that the funds have arrangements with the underwriters. So even the insurers that we do work with, say like TAL and AIA, they tender their offerings to the industry funds, and they can change that every few years, which can change the rules and the sums insured and the premiums that the members are subjected to, even without your consent or even really being informed until it's going to happen.
Yeah, that's an area that is probably not understood as well is the fact that the terms and conditions can change. So if you go and increase your cover with a fund and say $1 million of life and TPD and income protection, the super fund, if you've gone and increased it for that much, the trustee, I don't believe, will change that level of cover if you've gone and increased it and gone through underwriting. But they can change the terms of the contract. So they can say, hey, if you receive a TPD payment, then you no longer get income protection ongoing. And so it foregoes that income protection policy. And that's something that today may not be the case. It is the case in some funds, but it may not be the case with all funds. But over time, as they manage their costs, that's a great way for them to manage their costs. And as a trustee of the fund, they've got to protect all their members. They've got to protect their super assets. They charge on an asset-based fee. So there is a quiet conflict of interest there for them to manage that. They want to minimise the insurance cost to keep the asset pool as high as possible. So as a trustee, they've got to manage that on their members' behalf. And so doing these things that can significantly reduce their hundreds of $1 million insurance premiums that the fund is paying out to the insurance company, to go and bring it down by 5 or 10% can have a significant impact on their overall bill. And so they're just changing minor tweaks to it. And so that's what guaranteed renewable is when we set up a policy, it's a contract between the individual and the insurance company, and it cannot change. And so that's why it's super important to not just solely rely on the super fund cover.
I have a question.
Yeah.
Australian Retirement Trust, with their TPD offering, it's called TPD Assist.
Yeah.
And it's not a big lump sum payment all at once when you satisfy that condition, but it's split into, I believe, 4 to 6
I think
payments.
it's 6, but it could be 5. Yeah, whatever.
Yeah.
It's a number of payments, yeah.
So for Australian Retirement Trust members, was that changed when that was brought in, or is there some legacy standard TPD members and some with TPD Assist?
So Australian Retirement Trust is a funny one, and this also goes to this guaranteed renewable and why that's important, because super funds are merging and changing as well. So Australian Retirement Trust came out of Q Super and Sun Super, two of the biggest Queensland funds. They merged and became Australian Retirement Trust. Q Super actually had their own insurance company, Q Insure, that got taken at federal court for overcharging premiums, but that's okay. We won't talk about that. And Sun Super had AIA as their insurance provider. When they merged, they actually kept both, depending on different members. So ART have gone with AIA cover. And there is a section of ART that is Q Super, that's like for Queensland government workers, and they still, I believe, are covered by the Q Insure policies within their membership base. It's a bit confusing, but AIA, those policies, is based on that TPD Assist, and that's where they came out and made that change. So anyone who was a Q Super member who wasn't a government employee rolled into ART and then got their policies went from Q Insure to AIA effectively. Now, as a member, it all looks the same. You wouldn't notice the difference because most people don't read their statements. But that is a significant change. They went from having a TPD policy that Q Insure offered, which was a standard TPD policy, a lump sum, and I think it was around the $250K, to an ART policy that may have moved from a more lump sum to a stage-based payment. So again, back to this point of like why I personally don't have my cover 100% through my super fund or through an industry super fund is because I don't want a super trustee and an insurance provider to negotiate on costs and change features and benefits. When I signed up for the fund, maybe it had everything I wanted, but then 5 years later when I claim on it, the terms are very different. So, yeah, we've gone on a bit of a history lesson on Q Super and Sun Super. But, yeah, it's an interesting kind of dynamic. And, again, with all the mergers and with all super funds, there's huge amounts of mergers happening. Those super funds need to make a decision. Which insurance policy do we keep? Do we go and retender everything again or do we use one of them? And then it's a discussion of going, do we use our one that may be better for members but costs members more, or this one that's worse but is cheaper for members? And so there's always this balancing act for the trustees. Yeah. So anyway, we're going well off track, but it's super important for people to understand. The other thing that I think we didn't touch on too much is increasing the cover through the super fund. When I asked, well, why don't we just go and do that? Understanding, is there underwriting when we go and increase the cover through the fund, other than these special, these Danos Direct special deals that we're offering? Is that still a thing these days? Danos Direct? You reckon? Yeah, that'd be good to know. Outside of these Danos Direct special deals that the super funds are offering, do we need to go through medical underwriting, and do we need to disclose pastimes and all that medical disclosures?
Absolutely. The process can be very similar to going through underwriting through going through us and us taking care of as much of the application as we can, but you'd be responsible for all of that and completing all of the personal statements by hand, and they will be assessing you through medical underwriting, as well as occupational underwriting and pastimes and smokers' rates, and all of that can also be taken into account too.
Yeah. So that's another reason why we just don't go and increase it through the super fund, because often the terms will be the same, if not potentially worse sometimes, than going through a financial advisor. So there's limited upside doing it yourself, going through the super fund and increasing it, and potential downside. And as you mentioned, on a like-for-like basis, super funds charge a significant amount more than an advised policy, where we are paid a commission, and theoretically, we're all being told as Australians, don't ever go to something that gets paid a commission because they're boosting the cost. But the landscape means that the competitive environment is to try and win that business, because we're tendering it to all insurers, not just the one insurer.
When you go through underwriting through an industry fund, do they request medical reports?
Yeah, same thing. Yeah, so I've spoken to quite a few group insurance underwriters, and the same thing. So if there's an outstanding medical test or previous medical test, they'll ask for those medical reports, and that's where sometimes people come to us and go, the industry super fund took 3 months to assess my application, and our response is, well, we may have the same experience with any insurer that we look at. So,
although we may be pushing them a little bit more, following them up a bit harder, rather than just letting them do their thing.
We talked about the insurance terms can change without you knowing. But another question is, can you actually lose the insurance policy altogether within your super fund without knowing about it?
Yeah, this has become a hot topic, and because in the past few years they brought in the Protect Your Super legislation to prevent people that have, say, multiple super accounts with multiple different insurances that they may not need, and having their super balances eroded by those premiums. So they brought in these sort of rules, being like, okay, you haven't received any contributions for 16 months, then you'll lose your cover unless you say opt in. So that's one of the things that whenever we recommend clients retain their cover, make sure they check in their opt-in status, because things like going on maternity leave and having over a year off from work could mean some employer contributions aren't going in for that long, or if you maybe take some time out of paid employment to go start your own business and you may not know, suddenly those contributions aren't going in, you could be at risk of losing that.
Now, is there any other reasons why we can lose it outside of not contributing for 16 months? And if we have lost it, can we just call up the fund and say, hey, bros, can I just get it back again?
Typically not in the latter. Often they'll just say, sorry, bad luck, unless there was some administration issues where they didn't send a letter when they should have, or you can pick on them saying they didn't try hard enough to inform you. But in terms of losing any other way, typically if your balance isn't high enough that you can pay those premiums, some super funds will say if your balance is under 6,000, then your super can be at risk of being a low balance super fund and being rolled over to the ATO.
Yeah, and I mean the other thing is that, like, at the end of the day, the super funds, they can be as nice as as they want, but it's a legal requirement. So that's why even that 16-month contribution timeframe, sometimes they bring it earlier and cancel it a bit earlier, because they want to make sure they're not breaching their superannuation legislation. So that's why, like, if it does get cancelled and you go, can we just reinstate it? They will be like, no, we legally have to cancel it. And it's and they make a risk decision not to reinstate it. So yeah, once you lose it, it's unlikely to be gotten back again.
Without going through underwriting and whatever else.
Yeah.
And so it's very important to keep an eye on any correspondence you receive. Don't just assume it's just an annual update of what the CEO is doing or the performance. It could be something important like that. Looking at changing your address and your email address if those things change as well, very important.
So we've previously done a episode with Eddie on future insurability. So being able to go and opt to increase your cover. Now, do any of the super funds offer these kind of options?
Yes, some do, some don't. For example, Hester doesn't, but most other super funds do include life, and with one super fund, Australian Retirement Trust, age events as well. So if you turn a certain milestone birthday, it's not something you're really thinking about. Yeah, I've turned 30, now I can increase my cover, but it's something you could potentially utilise. Other main ones are taking out a mortgage or your child starting primary school. Those sorts of events can be triggers, and you might need to utilise that option within a certain time frame. It's typically like 30 to 90 days if they're generous within the event happening, or with some funds it's also that, or within 30 days of your annual statement being received as well. So it's important, just be aware if that's something you'd want to consider doing for yourself, just keeping mindful of what sort of events that might be applicable for you.
All right, so we've talked about default cover. Does it cover everything? What are we missing if we're relying just on the default cover, or even if we go and increase it within the super funds? What are we missing out on?
So no, it doesn't cover everything or every event that a typical retail insurance policyholder could utilise. For example, when it comes to trauma events, that's unrelated to, say, you passing away or you being not able to do your job. It's based on diagnoses. So that trauma cover is not available through super. Therefore, none of the super funds will have that as an optional benefit to take out. As well as when it comes to income protection, like we said before, typically that default offering is limited to a 2-year benefit period, or perhaps up to 5 years with, say, Hester, for example.
Yeah. A lot of funds won't allow you, even if you go through underwriting, to allow an age 65 policy. Yeah. The other thing is I just thought about is they are limited to, now I'm going to geek out a little bit here, they're limited to the superannuation limitations. So things like income protection. If you're not gainfully employed at the time you have an injury or accident, so you go overseas, you quit your job, you go, I'm taking a gap, few months, I'm going to go overseas. You're not gainfully employed at that time, you injure yourself, you do not get any income protection. It doesn't matter what you do, say, whatever, you're not eligible because superannuation law says you're not eligible. And so you haven't lost in income because you're not gainfully employed. So that is a limitation when retail cover that we help set up has some protection mechanisms for that. Other things are like TBD, own occupation TBD. So it is limited to can you do any occupation? And some super funds have that based on can you even retrain into other occupations? And so those definitions within super funds can be much more restrictive than like an own occupation. And we've helped multiple clients have a own occupation TBD claim. I actually think we've never helped a client with any occupation TBD claim, as in we've helped them with TBD, but it's always come under an own occupation definition, which is kind of further convinced me of how important own occupation is.
And when that happens, it's because it wouldn't have been approved under any occupation.
Yeah, exactly. If those clients relied on this super fund cover, they just wouldn't have their TBD payout. And so, yeah, they're some of the limitations within like the super funds, regardless if it's default cover or tailored cover, you just can't access those additional benefits.
A couple other limitations I've seen in certain super funds is they will not pay a, say, income protection claim for mental health over a couple of years beyond that. And there is even one where they wouldn't pay a partial disability benefit under income protection. It's either you receive the full benefit or nothing at all.
Yeah, so you can't work 5 hours a week or 10 hours a week and then have that income protection supplement your income.
Yeah, fully off work.
Do you know who that is?
Super SA.
Super SA. All right. And do you know who the mental health one? If you're not sure, don't name it.
No defamation here.
Yeah, all good. All right. A comment I hear a lot is if someone's at a barbecue and talking about insurance, which no one ever does, but it might happen sometimes, especially if someone's experienced a claim, they might talk to others about insurance, and then the response is, "Nah, I'm all good. My super's got me all covered." What would you say to someone who says that?
Well, I'd also ask them, have they actually looked at what they have inside their super fund, or are they just assuming, yeah, I think I've seen it on the portal once and it said I have life and TPD, I should be all good. Or if they're like, oh, I know my partner has the same super fund as me or a similar super fund because we're also with an industry fund, it should be all good. So that's where I'd also make sure that you compare the pair and not just rely on the fact that you've got an industry fund and their insurance is all good. So I just say, just because you're insured to some degree doesn't mean you're properly protected.
And the other common experience is some people go and apply for cover through their super fund and get declined, and they think that, well, they can't get insurance anymore. So what would you say to those people?
Well, that's where we look at some of those other options available to you. So just firstly, making sure that you are fully aware of what you have inside your super fund, checking that you've opted in to make sure that it is protected if you do need to go off work for a little while. Consider if fixing is a viable option for you. Are you at that top end and starting to come down with your cover? Consider fixing then. And then also being aware of, does your super fund offer those life event increases? So you know, okay, well, I know I was going to look for getting a bigger mortgage next year. Is that one of the options available to you so that you can utilise that when the time comes?
Yeah. Two other things I would say. Number one is go speak to a financial advisor, because the super fund only has one option and that's it. And so not all insurance companies have the same assessment. So if you speak to an advisor, yes, the super fund, Australian Super, they use TAL. TAL says no. Okay, well, we've got 8 other insurers or 10 other insurers who we can look at, and maybe someone will offer cover. So definitely speak to a financial advisor. And the other thing, what was I going to say? There was 2 things. What was the second thing? Speak to an advisor. And the second point is underwriting changes over time. So you may have been declined 3 years ago. And a good example is during COVID. If you had COVID, insurers weren't offering cover for like 12 months post your recovery of COVID because insurers were so unsure of what was going on. Now it's a non-event. It's just like having the flu. And so if you've previously been declined for a number of years ago, or even now, speak to a financial advisor because there may be other options, number one. But also, if it was a number of years ago, underwriting may have changed. So even if you went to an advisor and you got declined across the board with everyone, 3 years later, it may be very different because you're a number of years away from some of the reasons you got declined. And underwriting always constantly changes, and that's why we're in a job.
Yeah, I had a client just recently in an initial call tell me, I was declined because I've had breast cancer and they needed to see X number of years being symptom and treatment free, remaining in remission for that long before they would consider cover. But coming through us, we had multiple options available to them, and it was certainly not that dire.
And great point. Also come to Skye because we're the goats. And there is value, and I'm being a little bit facetious, but there is value in a firm that does it day in, day out and specialises in it and has great relationships with the underwriters. And there are plenty of firms in the country who are, it's not just Skye, but there is a huge amount of value in going, well, we know the insurers know us really well, and so we can't get someone who is a clear decline for everything insured because we wave our magic wand. It's not like that, unfortunately. I wish I had a magic wand, but we do often have a lot more options and a lot more sway with insurance companies because we have great partnerships with them and great relationships with them. All right. I think this has been a great episode. I love doing deep dives with you, Lenny, because you way over prepare, and that's the best thing about it. But and the thing about this episode that's been good is often, advisors think, industry funds are garbage, they're no good. And at Skye, we've never believed that because there are values. So just in summary, what is the best thing about industry covers and where do you see the biggest gaps?
The best thing is that super funds do offer some form of default cover to most of their superannuation members. And the biggest gap is that people rely on the fact that they have it and without thinking that perhaps there are some gaps in terms of how much they're insured for or for different types of benefits that they could be eligible to be claiming for. For example, income protection, much higher likelihood of being able to claim upon that than, say, TPD.
Yeah, and these days most super funds are getting rid of income protection as their default options, unfortunately. And for me, thank you for asking my thoughts. I agree with you in terms of the biggest benefit. They offer default cover, and it's great that they do offer it. Some of the gaps is it changes. So it's kind of, you just always got to be on top of what changes are happening. Previously, you may have had income protection, but these days it's much less common. And so, even though you had it at one point in time, the super fund can remove it from your you as a member. They no longer offer it. So that is the biggest gap. That when you set it up, you know what you've got, but then when you claim on it, things may have changed completely. So that is a big gap with the cover, but it is the nature of having those group policies. Well, thank you so much, Lenny. This has been a fantastic deep dive. If you enjoyed watching this, I'm sure you'll enjoy watching our other deep dives that you'll see on the screen now. Thanks heaps for joining me, Lenny.
Thanks for having me. Take care, guys.